Welcome everyone to another True Potential Do More With Your Money podcast. It's the Brian Adams episode. This is episode 69 and we're recording this on Friday the 21st of May. And a big warm welcome to the new True Potential podcast studio. It's the Pod. And the very first thing we're going to be talking about in the podcast studio today is fire. Now don't worry, this is not a health and safety podcast you've tuned into. It's a wealth and safety podcast. And we're talking about fire, which is financial independence, retire early. We will explain all about what that means very shortly. But trying not to set fire to the podcast today, we are joined from left to right in a clockwise fashion by Daniel Harrison, Steve Hudden and George Bell. Good morning, gentlemen.
Good morning, Peter.
It's very impressive, this our new home today, isn't it?
It is. We're having a pod party today, Peter.
A pod party in the pod.
Yes, many pods.
Yes, indeed. And Dan, I hear that you have been physically and the brains behind this new studio. You've been in here with your Black & Decker every Saturday, I hear.
Every Saturday, Peter. I like to keep my hand on the tools.
That's right. Yeah. Well, indeed, absolutely. Tell us about it then. So it's all part of the new office refurb, but
it is.
It's
very
impressive.
I know we've talked a bit about the refurb as we've been going along, but this was an element we wanted to do actually this time last year before we weren't allowed back in the building, which was just to dedicate a bit more kind of bespoke space for recordings like this. We also do a lot of, say, George does the daily morning markets, and over the last year we've been doing them from home, we've been doing them in the office a bit, whereas the space now, and hopefully ladies and gentlemen you'll see it, we better sound quality, better video quality as well. We've got just off camera, we've got the dream team of Katie and Graham as well operating away, so this is quite exciting. It's like Christmas come early.
And I can tell they're very nervous because you're the only one with an unscrewed bottle of water, so...
That's not water, it's gin.
Oh, well, even better, even better. So when it does get tipped over, we can all just have a good laugh.
Yes.
Excellent. Well, look, a little music quiz to start off with. Can anyone name a song that has fire in the title? Well, go on, Steve, I'm looking at you. You look like you're raring to go, Steve, come on.
Well, the most famous one, Peter, would be from The Crazy World of Arthur Brown. Fire. You've taught me to learn, or burn, even. George, over to you.
I thought I was going to kick into a song there. I thought
I was waiting for you to sing it. Yeah.
I nearly did.
I'm going to go Firestarter.
Oh, very good. Yes, very good. Daniel?
No. Arcade Fire, they're a band. It's not a song. But
well, actually, I thought you'd go for the classic 1984,
Come on, baby.
I'm on Fire. No, I'm on Fire by the boss, Bruce Springsteen, because he is the boss. See? Missed the link there, Daniel.
Too young.
It was all set.
Too young and dynamic to know about Bruce Springsteen.
Well, look, let's...
I'll warn you which of the jokes he's got noted down here.
They're not noted down, George. They're all in there, don't worry. But I'll hand over to you, George, because you can tell us what's down this week in the markets.
Yeah, of course, Peter. So I'll run down the asset classes and then we'll maybe open it up just into 2 or 3 themes, key topics over the week. But in terms of equity markets, positive week overall in the UK. You've got FTSE 100, which is up around 80 basis points. You've got the FTSE 250, which is up around 1.5%. You've got small cap, which is up just over 1%. In the US, you've got the S&P 500 up around 45 basis points. The Nasdaq, stronger week there, around 2.4%. And the Russell 2000, which encompasses a greater number of smaller cap companies within there, up around 1%. In Europe, around 1.2% for the week, but a really positive start there this morning after you had some strong PMI data, which is leading indicators around output, around new orders on both the manufacturing and the service side. There, Asia was up overnight, but in terms of volatility within the equity market, you've got the VIX index, which we often talk about. That's at a level of around 20 at this point in time. It's spiked up to around 25 on Wednesday, but we'll maybe get into some of the reasons for that as we work through. In terms of bonds, bond yields pulled in across the way in the UK. 10-year and 30-year bond yields were in around 3 basis points on the 10-year and 1 basis point on the 1 year. So a bit of curve flattening there. In terms of the 10-year yield at this point in time, gilts yielding around 0.84%, 30-year around 1.4%. In the US, 10 and 30-year again, they were in around 3 basis points across the piece there. So you've got the yield on a 10-year US Treasury at around 1.63%. You've got the yield on a US 30-year Treasury at around 2.33%. In terms of the MOVE index, which again just gives you a bit of a feel for volatility within the bond markets, that's been pretty steady over the week. So MOVE index is at around 55 at this point in time. In terms of currency markets, the dollar's a little bit weaker this week. It's down around 60 basis points. So the Dixie index, which gives you a feel against a basket of international currencies, is at around 89.7. So it's been above 90 for a period of time now. so it's dropped below that level. Sterling was down around 10 basis points, but if we look at this on a currency pairing basis, you've got sterling against the dollar at around 141, you've got sterling against the euro at around 116. In terms of commodities as a basket which encompasses energy, it also encompasses agricultural goods in there as well. We're down around 2.5%. You've got oil, which is a key component of that basket, down 5%. So Brent crude's currently trading at around $65 per barrel at this point in time. Gold is up around 60 basis points. But we discussed last week quite a lot around the US. We talked about the employment data. We talked about the inflation figures as well. This week, probably worth touching on 3 areas. I'll maybe pull out the UK inflation reports, and I can add in the retail data which just came out there this morning. Bitcoin, we'll talk about that, the extreme volatility which you saw in the markets there on Wednesday, some of the reasons for that, and the minutes from the central bank in the US, the Federal Open Market Committee. So they had their meeting in April, but analysts really look forward to those minutes which come out a few weeks later. In terms of the UK inflation prints, so UK headline inflation came in at 1.5% in April, so up from 0.7% in March. That's in line with the expectations were set out there. In terms of core inflation, which strips out energy prices, that was up around 1.3% in the month of April, year on year. What's driving that? Similar to the US, it's the increase in activity which we're seeing coming through. It's higher energy prices, it's increased demand for clothing. So you're seeing a rise in demand leading to a rise in prices there. To a degree, inflation in the service sector was evident, but a lot of those inflation prints were taken one day before a lot of the non-essential shops and so on reopened. So another way for getting a feel for that level of demand is probably coming through with the retail sales data, which is demonstrating a pickup, 42% year on year in April. So unsurprisingly, we were in lockdown this time last year, but around 9% month on month. So you're seeing a strong expansion there in terms of activity levels and recovery. I suppose looking ahead in the coming months, and what did we take from the comments from the inflation report? Well, we know the inflation target is around 2%, so we're still below that. We've still got some way to go. Andrew Bailey, the governor of the Bank of England, did acknowledge the inflation prints are coming through quite strong and does expect those to rise in the coming months, similar to what we see in the US, but broadly for that to be transitory. And while they're saying it's transitory, they are still very much poised to respond in terms of the policy levers should they need to control inflation overall. The other aspect was Bitcoin. We talk about Bitcoin on the podcast quite often, mainly around the volatility aspect. Wednesday was a classic example of that. You saw in the morning trading, Bitcoin was down 31%. It was up around 33% in the afternoon. Not many asset classes in the world trade on that sort of level of volatility. But what was driving that? You had the People's Bank of China, who came out and said that they were tightening their ability for institutions and for corporations to use cryptocurrency as a payment mechanism. People's Bank of China are in the process of building their own digital currency, which will give them more oversight, more transparency in terms of payments there. So unsurprisingly, they are squeezing this part of the market. You also had Elon Musk, who's the chief exec at Tesla, who is leaving cryptic signals on Twitter every other day, but essentially comments last week, he pedalled back on the initial stance which he took earlier in the year that you could use cryptocurrencies for the purchase of Tesla cars. He pedalled back because to actually mine cryptocurrencies, it uses a lot of energy. It's quite it doesn't fall in line with Tesla's environmental and energy policy. So he was backpedaling there. The afternoon though, Bitcoin started to rebound. The reason for that is he put another message on Twitter, really to suggest that Tesla weren't one of the sellers of Bitcoin in that morning trading.
I don't believe him, by the way. I think he wants to go to jail for that, actually. That's, it's... and I know he'll probably go on Twitter and call me a pedo, like he did to the last person who publicly criticised him, that poor diver across in Thailand. But I think it's nothing short of a disgrace, actually, what he did. And yeah, maybe Tesla didn't trade in it, but that man will have certainly done a spin on it. And I think this is half the issue with unregulated things like this. People can go on. Yes, you may get a bit of a slap from some US regulator, but as we've talked about before, it's, Bitcoin's no better than a gamble, and it's not subject to the same, say, investment regulation you're privy to, George, you know, and the instruments we tend to deal in.
Absolutely. And I mean, you know, Twitter is a tool to communicate your views and express things like that can be really dangerous. We saw this with under the Trump administration, that Twitter can cause a huge amount of volatility in assets. It's really, you know, if those investing in Bitcoin and cryptocurrencies need to have a really strong awareness as to what it is they're holding and the experience you can have in volatility there.
Yeah, it was interesting as well. I was out with a couple of colleagues last night, and I got a taxi home, and the taxi driver spoke for 20 minutes about Bitcoin all the way home. But actually, I thought as he introduced us, I thought, oh, here we go. I'm going to hear all about why Bitcoin's great, and he was actually deadly against it, and he was.
I thought you were going to say you paid for your taxi in Bitcoin. Did you?
Yeah,
he let you do that.
He did. Well, it was. I had enough Bitcoin at the start because of the volatility.
Yeah,
but
by the
it's by
time
the end of the
10 minutes later, he owed you money, or you owed him money, or something.
Yeah.
Does any of that feed through into your conversations with advisors, Steve? Is Bitcoin still a thing, or is that washed through?
Bitcoin is a thing. It's a thing for the younger generation, particularly. I think listening to us all speak there, it's ominous sort of, you know, recollections of the dot-com bubble in the sort of when it. You know, when tech stocks took off in the late 90s, they were a great investment. But then when the herd mentality followed it, you know, you missed the boat. And Bitcoin to me is a gamble. And that's not just me speaking as a generational sort of old fuddy-duddy. It's a gamble. And if the price can be manipulated, 31% in the morning, I mean, really? I mean, to a degree, all currency is virtual. You know, whatever money you've got in the bank, you never really see it in hard. But I just think the manipulation and the unregulated nature of it is really dangerous. And I wouldn't recommend it in any way that it's part of your core, you know, retirement goals, objective setting. It's just a gamble.
Yeah, and George, well, thanks for that reflection on the week. Looking ahead to next week, obviously, morning markets will be back. We'll be able to check in every day and see what's what. Anything particularly you've got your eye on for the week coming?
I think at this point in time, we'll probably be discussing a lot of the PMI data, which is rolling through still. Central banks and inflation really is the hot topic at the moment. It's what we've been discussing heavily with our managers to get a sense as to, is this something which is going to be sustained? If it is, you know, how do you want to be positioned within a portfolio? We do model out these different scenarios, but the core view at this point in time is, I suppose, reflecting the comments there from Andrew Bailey, that this is to be a transitory factor.
Yeah.
We came from a very low base this time last year, higher activity levels, higher energy costs. It's starting to feed through. But if you take the US, for example, they use what they call a flexible average inflation target, which means they set PCE inflation target at 2%. But we've been in a very low inflationary environment for some period of time. They're happy to overshoot as long as they are working towards that target over the longer term. The UK is an example. They recognise that higher inflation prints will come through. They are there to respond with policy if need be. But at this point in time, they're not looking to raise interest rates, which is the really important aspect.
Correct me if I'm wrong here, George, but it feels we're going to be moving into, we're moving into a period of more volatility. And we want to try and keep people calm now, because when it comes back, it injects emotion into your investment decisions. And generally speaking, emotion when it's relating to investments is a bad thing. You know, I'm not trying to tell people to stifle their emotions. This isn't some kind of middle-aged white man saying, you know, suppress your emotions. It's saying when you're talking to them in relation to investment, they are generally a bad thing. So please, I would recommend people key into the morning markets, but don't be tempted to do some sort of weird.
Well, we talked about this on the investment management podcast the other week. Of just let the experts do what they do. You know, you get on with running your life and let the experts get on with running your money, and you won't go too far wrong if you sort of follow that.
Yeah, but I think, as you mentioned, George, it has been a strangely volatile week this week. You know, which is, where it's me sounding like a broken record. I keep saying, I wonder if we've turned the corner yet, and we're starting to see an end to these extreme 1%, 2% swings up and down. Which is, say, if it just use the FTSE 100 as a proxy for that, there, it's been like that.
And last week it was we talked a bit about volatility, and where was that volatility? It was really in the bond market, because the bond market and yields were reflecting where they thought rates should be given the inflation prints that were coming through. This week it's been a little bit more around the equity side. But yeah, you know, volatility is still there. Volatility, you know, may not go away. So what can you do? Well, it's about managing volatility. And you can manage volatility within a portfolio construct, so stepping aside from single assets and building a model which we feel is suitable for those type of environments.
I think so, George, and I don't know if the camera will see it or not, so apologies if they don't, but obviously when you normally look at volatility, it can be like that over any sort of time period, and what's important is overall, is your investment going up. Volatility it's the nature of the market, ups and downs within there. So,
and if you're a regular investor, it can be a good thing.
Well, the regularity helps with that for sure. But I think that the other thing, which exactly linked with what you're saying, Steve, about kind of staying the course, is it can feel tempting at times to be logging in every day and is today a good day or today's a bad day, and you can see that, and I'm almost going against what we'd love as a company, because in some ways as a company we love everyone getting their apps and logging in every day just to interact with the True Potential software, but it's almost you'd be better off logging in once a week or once a month and just seeing how my overall portfolio is performing, because it smooths that volatility out. Then you don't see those such extreme swings.
Completely with that, Dan. I think you can overwatch your savings and your investments, so don't be tempted, because it will. Even the most sturdy of us, emotionally sturdy, if that's what I'm pretending to be, do get quite frightened when you look at your investments in the down. But as Dan says, just take a slightly longer time scale and look at them a little less often. Knowing that they're there, you can look at them whenever you want.
Over the last year, or 14 months, great example of, just staying the course and not panicking, not worrying too much about volatility, just having that kind of staying power, and markets come back.
Well, we can actually help with that. If you were to do a regular plan, if you like, one of a better adjective, and save on a regular basis, you will benefit, as Dan says, from the volatility by using pound cost averaging. And if you we won't explain it on the podcast, but if you want to know about it, come give us a ring or talk to your financial advisor, and they'll explain how a regular payment into a savings plan will help you benefit from the volatility in the market.
I think we've actually done a bit of a marketing pop here. I think we've done a Master Your Money series about direct debits and the importance of that. So do check out the YouTube channel, Peter.
Good plug.
Yeah.
Good plug. Right, well, let's talk about a bit more detail then. We're going to talk about FIRE, which is this concept of financial independence, retire early, which we'll get into. But can I just ask first, what's your preferred method of saving? What kind of saver would you say you are, George? Maybe come to you first.
Monthly. I almost think of it as a tax is maybe the wrong word, but I have a set amount which I look to invest each month on a direct debit basis, and I just take account for that when I'm planning forward. I'm quite in terms of the app, I'm one of those who do log in on a regular basis. The only reason for that is because of a lot of the content on the app in terms of commentary on the markets comes from me and the team. So I log in.
You want to check out to make sure you've not been misedited.
Exactly. So, I'm a regular saver, a monthly.
Are you, Steve? Are you beginning of the month, middle of the month, end of the month, or just whenever?
I'm at a different stage of life to George. You might not have realised, everybody. I'm definitely goal-based now. My goal is financial independence. I like the beginning of FIRE. Financial independence is something, certainly for the last 10 years, I've really been focused on. When I was younger and I had young kids, it was often hard to keep focused on where I was going with my money. And I was a regular saver then. I'm of the generation that's fallen into the trap between having the nanny state look after me, so having a defined benefit pension scheme, which I did have, I've moved mine, but having that, but also having to save in a defined contribution, so save as well. And I think that I've gone through the transition where it's quite clear now that the government will not look after me and will not look after my retirement, so I've had to take it in my own responsibility to do something about it, which, similar to you guys, the younger generation, you've grown up in that. So the benefits of age, what are they? Well, I don't know. One of them is, if I could tell, and I tell my kids and I tell you guys, the sooner you can start, the better. Because time is something you can't get back, so you need to start. And regular saving, definitely the right way to do it.
Dan, are you
a rule of 72? The rule of 72. Divide 72 by your growth rate, gives you an idea of how long it takes to double your investment. You can really shorten that experience though if you do have regular investment.
In the earlier. So were you an early saver, Dan? Were you saving in your early 20s?
Yeah. I made the mistake when I was 18. I worked full time then. I remember earning £9,600 a year when I was 18, and it was £800 a month. And wow, I've got all this money, and I've made the silly mistake of buying a car on hire purchase. And I remember the price; it was £332. a month then. And so when you first sign it, you're like, yeah, I can easily afford that. And then after the first month, you actually realise that's a lot of money coming out of £800, you know, obviously before tax and things. So once I got shot of that car, yeah, I did actually start to say, and I have done, I've always tried to fill my ISA where possible. And probably when we look at the different savings approaches, I'm probably bang in the middle. And as far as if I've got the money, I try to make sure my ISA's filled straight away at the beginning of tax year. Because then I think I get the 12 months tax-free growth. Yes, of course I don't make the most of, say, pound cost averaging by putting in regularly, but I do that with a direct debit saving as well, which goes into a GIA account as well, and comes out first day of the month. And I must admit, I don't miss it now. Once the same with, say, paying for the car, on the flip side, paying for a direct debit, after those first 2, 3, 4 months, you're used to it then. You're spending, your income or expenditure needs level up, so to speak, or
and that's a great point. It's getting into the habit. And people say, you know, I know for myself, I am a creature of habit. You know, I used to get the 6:19 from walking into Waterloo, and every day without, you know, I know what time I get up now, and I know what time. Weird, but habits are good if they're good habits. So you need to get out of the bad habits and get into the good ones of saving. And again, you can't do it too soon. So.
Well, let's get into it a bit more then, talk about this concept of FIRE. So if you look into it, it goes back to a book in the early 90s called Your Money or Your Life, which was quite an interesting read, I'm quite sure. But it really kind of caught a light, I should probably say. See what did that, George?
It's beautiful.
Maybe in the last 10 or 12 years or so. And the idea really is that you really kind of bear down on your expenditure, cut away on the things like Dan says. So if you've got, you know, whether it's the car or whatever, but really aggressively trim down on items that go out of your bank account each month, and then squirrel that money away and whatever else you can afford into savings. And when I'm talking about aggressively saving, it's between 50 and 75%. So imagine whatever your take-home pay is each month. Can you save 50 to 75% of that every single month religiously? And to do so over maybe 15 or 20 years if you're starting in your early 20s. The concept being that if you can do that, then you have a fighting chance, if you can get the good kind of growth rates that we talked around, of potentially retiring in your mid-40s, let's say, which sounds quite an attractive proposition, but you've really got to spend 20 years of really tightly controlling what goes out and aggressively saving as well, which for most people is probably I would imagine, quite a big struggle, Steve.
You know what, for me, the concept is brilliant, that you can save as much as you can, as early as you can, which I've been sort of saying. There's some element you've got to live for today as well.
Yeah.
You know? So I think it's like anything, if you constrain yourself too tightly, you'll just throw it all away. You'll break out and get rid of it all and sort of abandon everything. So it's a kind of, you should look at picking the bits that you can actually do, but then trying to stick to them. And as Dan said, it becomes a habit that you don't even notice anymore. I think if you're not going out for dinner and living nearer to work and moving back with your parents, I think it's going to constrain people to a degree that they'll soon get fed up with that. If you can do it, great. You're not.
Well, you mentioned it before. You almost break down FIRE into two bits and talk about financial independence. Building up financial independence, fine. You know, retiring in your 40s, and you can't even access your pension in your 40s. So there's where is that money going to sit and all the rest of it. But you're right to say that having no life when you're in your younger years, you know, it seems a bit of a strange thing to do. Yes, you could potentially retire in your 40s or 50s, but by then, you know, you've missed out on some great years, possibly.
As you can see, I lived a life when I was younger.
Yeah, you do.
He's really only 35, you know.
Yeah. But it is. Look, your 20s are some of the best years of your life.
Yeah.
You know, and it's. You still in your 20s, George?
Still in my 20s.
Still in your 20s. So George is living his best life right now. This is as good as it gets, George. But no, I think it is, and I almost see it being akin to being, say, on a diet as well, where let's say you want the 6-pack and things like that. You've got to really drill into what you eat. You've got to count your macros, you know, and things like that, and make sure you're getting a certain amount of calories. So you've got to cut out all the fun, basically. And it's the same with this. If you want to save 50 or 75% of your income every month, you're cutting out the fun. You know, imagine you've seen your girlfriend, you want to go to the cinema tonight, and they go, oh no, this is not in the budget, you know.
And doing that for 15 or 20 years as well. You know, it's not even, you know, a diet. You might think, well, I'll do it for 6 months or a year's worth or 3 months or whatever, but 20 years of that would be, you know.
It can make it, I haven't done it, by the way. So, but before anybody comments on here and calls me a rage and whatever on any YouTube channels, I haven't done it. So I'm not an advocate, but I'm looking out from it, and it just seems a miserable existence. I must admit. And imagine your poor mum. You're 30-year-old. Hello, mum.
Have you not left yet?
Yeah, time for fire. I'm moving back in. Your mum's like, we just got rid of him. It's. I think it can be quite a selfish outlook on life, which is screw everything else. I'm putting my head down. I'm saving money wherever possible. I'm putting my costs onto my family or friends as well. And then let's say you hit 40, you've missed those 20 years of living, of fun. Now, I know part of the FIRE movement as well is you're meant to find a like-minded partner as well to make more of it.
Yeah.
But you probably hit 40, you're all alone. Like, hey, George, do you want to go out today on a bike ride? You, no, mate, I'm at work. You think, well, I'm retired. You think, well, good for you. So you could end up, and I know also the intention is then you go around, you have adventures in the world. And that's it as well. But again, the last 14 months has probably shown us. Imagine if you'd done the old retire early then, you'd just sitting in your bedroom. You can't.
Well, and also
go
the other
anywhere,
point is if you do retire in your 40s, you've got to make that money last perhaps twice as long as a standard retirement would be.
Yeah.
So hence the reason why you've got to be saving 75% or so to get to that figure that can last you for maybe 40 years.
Well, this is where the rule of 7 kick, or the rule of 4, isn't it, comes in, which is part of the idea with this, which is you kind of need. You can take, you assume inflation's going to be at 3%, so you can take 4% out, on a normal growth of say 7%, and so it should look after it, and that's how you then meant to make your money last. Mm-hmm. But again, so you live like a monk for 20 years to get your accumulation side of things, and then you've got to live like a monk
for the
for
the rest of your life.
Decumulation. I just think surely there's more to life than just not having.
Well, let's talk about the first bit, as I said before, financial independence, because there is something in that, which is saving early, but without absolutely destroying any kind of fun that you might have had in your life, but just building up a pot of money that can, whether it's rainy day money, as some people call it, or whether it is into your later life and your pension. What are some of the ways that, Steve, clients and advisors that you talk to, what are some of the tips and the ways people can, if you like, develop financial independence?
One of the best things about the FIRE movement, about podcasts, about everything, is we're encouraging people to talk about their money. It's the first step, and so if you've gone to talk to a financial advisor, you're making the right first step, or you've communicated us, or you've looked on our website, or you've watched the morning markets. You're taking the first step. You're starting to think and talk about your savings. It's almost like a health issue. People don't want to talk about them. We need to talk about our finances. We need to talk with people who know what they're talking about back to us and consult. So, financial advisors are the best people to talk to. They will help you make use of your tax allowances, because don't forget, let's take a pension for example. If you're a higher rate taxpayer, the investment that you're getting, it could be 40 to 45% of the taxman's money, which is your money anyway, by the way, but they'll give it back to you. You're getting growth, as Dan alluded to with his ISA. You're getting growth on someone else's money. So you should go and talk to your accountant or your tax advisor, or I'm actually not. You should talk to your financial advisor about how you can use your tax allowances and get other people's money to grow for you. But start the conversation. And we use our slogan, do more with your money. It couldn't be more apt. You need to start talking about it.
Yeah, and early, as you say. And in terms of some of the tech as well, I mean, we're in a different world now. Perhaps even when I started saving into my first pension in my early 20s, it was you had no idea what was doing. You just get a statement once a year, and that was it, and didn't make an awful lot of sense anyway. But now, especially with technology, it's much easier on the way in to save, and much easier, as we talked about before, to keep an eye on what's happening as well, isn't it?
To keep an eye on what's happening, and I think as Steve was saying, the part of the financial journey which Steve's at now, he's got the goals set within there. And again, if you're considering this image which I was shown before with the performance chart, what to say the TP tech lets you do is you can also set a goal setting chart as well, which gives context then, which is how is my portfolio actually performing against what I want to do. Hopefully it would be above there, but if it's not above, it's where you've got other bits of tech. You've got Impulse Save, for instance, which lets you take bites out. So direct debit's great because it's on autopilot, for instance. Once a month it comes out, and that should help you get that steady growth within there. But if you are seeing a drift within your goal and you do have spare capital, something like an impulse save is a great bit of tech, because you look at the gap to goal, it actually calculates it for you on the true potential side of things. Your debit card's saved and off it goes. So it works wonderfully well, but I think it all goes back to, again, what Steve's saying about being in control and being in interest of your finances. If you don't need to be, like to the level of George, where George is such a big brain and such intelligence about what's going on with the markets, because it's not just your job, George. I think it's a real hobby of yours, an interest, a passion of yours. You don't necessarily need to be at that level of it, but you do have to remember it's my pension, it's my ISA, it's my retirement. So do take some interest in where your money is and what you're trying to do with it.
Has everyone got their phone with them, by the way? Who's got a phone with them?
Mine's outside.
Mine's down there. And
Have you got your phone with you?
I don't. No.
I was going to get you to do an impulse save right now and show how quick it can be done.
I'll do
Have
it
you got
like
yours?
this. Yeah.
Mine's in my bag as well.
Yeah.
It's really quick. We'll show you. We'll do it next week, or we'll do a video where you can see how quickly it is your impulse save. But you're right. In literally a minute, less than a minute, you can make those little quick interventions.
Yeah.
If you've got that 3 or 4 quid or 20 or 30 quid, bang, straight into your pension, and off it goes. And then these guys do the rest with it.
Yeah.
It's interesting when you were talking there, Dan. It reminded me of a study at Stanford University, where what they did is they got people to think about themselves and think about their financial circumstances today, and then measured what they call neuro patterns, so how the brain activity essentially, and then think about their future selves. And the neuro patterns, the brain activity was much lower when thinking about, it was almost as if they were thinking about a stranger. That's how much sort of compassion they had for the person which they will be at some point in the future, and how they think about, therefore, investing, how they think about saving. And what was quite funny is they said one way to approach that, to bridge that gap, would be to use one of those, the face age apps. I don't know if you've seen them, the terrifying things.
Yeah.
So if people are using them, no wonder you're not saving for that guy in the future, because I've done it on myself and it's terrifying.
Let's do it around the table, George.
Yeah.
We're a living app.
But so that's what a study which went on there. So the goal-based approach really works from our perspective, because it does make you stop and think. It makes you think about where you want to be, how you're going to get there, where am I on that journey, and how can I help close that gap.
Yeah, that's right. It contextualises why you're doing it, which hopefully motivates you to do it.
You'd hope so, and it makes it realistic as well, because again, we've talked about this on the podcasts before, that retirement now, I think it's not like, say, what previous generations were, where you'd be working in, if you look up in the north, you'd be working traditionally kind of manual tasks, so by the time you limp across to retirement at 60, 65, you're knackered. You haven't had the benefits that we've had in our society of better food, better healthcare, etc. So your retirement lasts a lot longer than what it did in previous generations as well. So I think you having that goal and having an idea about what you actually want to spend and do, say, in retirement is vital, because all of a sudden it's not just, I need my money and I'll go to the pub on a Sunday in my retirement. It's, as someone's described it many times before, retirement is a month of Saturdays.
Yeah.
Because it's what are you going to do for it, which I think is always what I don't like about the RE again and the FIRE movement. I think like we're all in agreement that the FI side of things, that the financial independence is fantastic, but retiring early and then having to have that discipline is darn tricky, because it's, I don't know, I think again, if we think about COVID, we think about the last 14, 15 months, one thing we've all missed, apart from the odd person here or there, is actually coming to work with purpose, doing something, coming in and seeing your pals in the office. And I've been back full time in the office 6 or 7 weeks now, and the days are faster, they're more fun, the more engagements I'm having as well with my friends and with my colleagues in here. It's
like you say, if you did retire in your 40s, presumably unless that other person that you've done it with, all your friends are going to be still at work and doing the usual thing. So what are you going to do? After a week of,
what are you going to talk about?
Yeah, exactly. There's only so much daytime TV you can watch. I've heard, Steve. The other bit of financial independence, of course, or the bit of FIRE, is not just how much can you save; it's what can you cut back on. Where can you cut back on costs? We talked about a few minutes ago, but I mean there are. I mean, I remember, the first time I'd met a financial advisor in my 20s, and the first thing he would do is, as well as a risk assessment, they would look at what have you got going out each month. But I mean, now with open banking, there are apps, and obviously our own TP Investor app can analyse. Some of that's not bad. Some of that is an eye opener to just how much you do spend on how many subscriptions you've got to things that you just perhaps you'd forgotten about, but they're still 5-10 quid a month or whatever. That stuff's pretty handy.
I think that's a good idea, having a bit of discipline and a bit of kind of housekeeping, so to speak. It's not a bad thing to cleanse your finances and check you are saving money, because otherwise you're just wasting it, and then obviously the more money you save, the easier it is then to say up that direct debit or establish one in the first place. I always think, obviously, when we're talking about, say, saving 50 or 75%, it's quite an extreme way to look at it. On the other extreme, you say, in the UK we've got workplace pensions, auto-enrolled schemes within there, and that's been a success because it just comes out your wage at source, and it obviously, but I think we probably all agree, the single-digit percentage isn't enough to help people hit the goals. But when you ask, and again, I ask some of the younger boys and girls here at work, and I ask, if you said, what would you feel like if we upped your auto-enrollment contributions to 10%? There's horror on their face. I can't afford 10% from my wages as well. So I think.
But actually, if you looked at some of those things that go out and you could trim them, you might be able to find that extra 15, 20 quid, which then becomes the difference between 8 and, say, 10%.
Yeah, and it could be, going back, slight defence of the FIRE movement, it could be, don't chop out having 4 pizzas, each Friday of a month. Maybe just chop out one, which is 10, 20 quid. Stick that in your pension, stick that in your ISA. It's. I think there is some elements of the FIRE thing which is good.
I think that's the discussion I think we've had, is that, if you like, insofar as FIRE is good at making you think about your finances and having a bit of a goal to work for, whether it is retirement or just something a little bit more in the longer term, or a little bit further away. Insofar as it focuses your mind, that's good. But how practical is it for most people to want to give up their early years? I can tell you about to say something, Steve. Come on.
It harps back to what we've been saying. You don't want to put too tight a restriction on yourself, because you'll give it up. Just like the diet, some great analogies. But equally, doing nothing is not the solution. You're going to get to a stage in life where you're going to have some money, and that money is going to have to work for you. So you need to start saving and get that money to start working for you while you're younger, longer time to invest, longer growth. And, I can't recommend it high enough. It's the only advantage of being a bit older that you can see. I often sit and I wish I'd just done it a bit earlier. I think I'm probably all right, because I did it in my 30s. I started to save quite seriously. But, if you could do it in your 20s, it's a good discipline, good habit, and certainly it'll serve you well.
Do you think people are saving early? I mean, just maybe anecdotally, or some of the conversations, do you think people are in their 20s a bit more? Because it's much easier now to just, perhaps there's more things to spend your money on. It's everyone's got a car on a PCP or whatever it is. Those things have become much more affordable, perhaps, than they were, when I was in my 20s, possibly. But do you think it's?
I think COVID is. We've talked about the pent up savings.
Yeah.
Over the last 14 months, 15 months, because people have nothing to spend. As George says, though, they're obviously out and spending there, which is contributing towards those retail figures which you referenced before. Rightly or wrongly, Bitcoin has brought the narrative into people investing, with the whole cryptocurrency side of things. So it's actually, gets spoke about in a taxi. The lad driving last night was a youngish lad as well. So it is maybe getting mentioned. Normally, you see, when people say, what do you do for a living? I just say, I'm miserable, so I don't really want to talk to the taxi driver. And obviously I work for an investment and pension company, and that shuts them up.
And then they talk about Millwall.
That's
Every London cab, they've all played for Millwall or had trials with Charlton Athletic.
Yeah. Well, I've got you, Governor. How about this? But now, unfortunately, I'm saying that I work for an investment and pension company, and people are now asking me. So I'm going to have to think of something else. I'll probably say I'm an accountant or something like that. That'll teach them.
Just say you're a Bitcoin billionaire. Just say that.
I could.
Yeah.
Yeah, and don't buy it, and then do buy it, and then sell it, and then do. Yeah.
I mean, a good bit of advice for my generation. Okay, I've got kids who are now in their 20s and 30s, and I feel I've got a responsibility. I don't think I ever told them about the birds and the bees. I think that was their mum's role. I don't know if she ever told them, judging about what's happened over the years. But It's a good time to have that conversation with them. I think as a parent, you've got to start having that chat with you, because there isn't this nanny state anymore. It will not, the government, as I keep saying, will not look after you into retirement. So as a parent, you need to start helping with their habits. Okay, you also start to look about how you will have an intergenerational pass down of your wealth. And that probably won't be enough to sustain them into retirement, but it starts the conversation. And I think there's never, it's never too early to start that conversation about your financial health.
Yeah.
Interesting. We'll begin to wrap up shortly, but I think it's maybe just ask you for one final tip to people watching the podcast and listening in. What would be your number one if you just maybe not quite, if people are not quite sure what's the best thing they should do, they kind of know they want to save a bit more or get started, but not quite sure where to start. What's the best bit of advice you would give them, George?
I would say, think about your retirement. Think about what you want. Speak to a financial advisor if you're unsure. I think one of the areas of concern which a lot of potentially younger savers who have not really had the experience of being in financial markets for so long is being concerned that they invest in the wrong thing or get stuck in something. That's why, speaking to a financial advisor, they can point you to what we call a discretionary managed multi-asset portfolio. We invest in a range of different asset classes, geographical locations. We invest with a number of different fund managers. So it's a very diversified investment solution, and we can help investors understand that. A lot of the work which we do in terms of morning markets, in terms of our regular content online, is really to bring people closer to what do we mean by an actively managed portfolio, where are these assets invested, and how are we managing that money on behalf of clients.
Which perhaps reduces some of the volatility, say someone like Elon Musk does. You said backpedaling, I might have said reverse gear, but
Exactly. It's diversification can help not only reduce the volatility, but it also gives you exposure to a number of different opportunities.
Yeah.
We've talked about equity markets and how they've been performing, especially since March last year. We know it's been quite an uneven path.
Yeah.
So positioning is really important in that journey.
Tips from me in relation to our first, podcast in the pod. I'd have thought about the joke a bit earlier about a pod, but I know we've had a whale of a time in the pod, so I'll progress with my tip for investing. For me, it's little and often. Start little and often, and then if you go to see a financial advisor when you've already started, you've got the habits going, he'll help you with your tax, using your tax allowances and all the things that George has said about investing in a managed portfolio. But don't wait to start. Start now, little and often.
Yeah, I wrote down the same as Steve. Just get started. I know we have a rich variety of clients. We've got kind of some clients just starting out at work on say they're on national living wage or real living wage, for instance, through to millionaires and whatever. And I'm often conscious you can sound a bit preachy telling somebody who may be struggling to make ends meet, which is, it's easy for you type of thing. I don't mean it in a condescending fashion at all. I think it's always been a criticism of the FIRE movement as well. It was for rich white tech bros was how it's described, which is it's okay for these multi-millionaires to talk about that, but not for someone earning £20,000 a year with a family and a house to feed. But it is, just get started. £1 a month is better than none.
You're on your way.
You are. Yeah. If you are part of a firm who has auto enrollment, don't opt out. Get it in there. It's you're like a well-known D2C brand who are not named. Your future self will thank you. In 20 or 30 years' time, for instance, even if it doesn't feel like you're saving a great deal. The effect of saving little and often over 30 years, for instance, is hugely exciting. It's great.
Yeah. So the FIRE movement is quite extreme, but the savings gap's also real. It's about bridging that.
Yeah.
Well, there you have it then. So the best thing you can do today is get your hands on the True Potential Investor app and hit that impulse save and put your first £1 or £2 in. And as we said before, you're on your way. So some good advice there. I hope that's been useful. Wouldn't be a podcast if I didn't ask you what you're doing this weekend. Weather doesn't look great, but any plans, Dan?
I've got to figure out how to get out of here because I thought when it was talking about fire, Graham locked the door as we came in as well, so it's a fire risk. Fire hazard in here.
Dan fitted the lock with his Black & Decker as well, so
I did. I got one of my tools out, George, and fitted that lock. But no, apart from that, Peter, I've got a pal coming up today from, he lives down in Warwick now, and I haven't seen him for a year or something, so he's actually an architect as well, so he's seen the office, and he's a bit of a nerd, so he's taken that as an opportunity to come up, have a look at the office, and then he's going to stay at his mum's tonight, not because he's a fire advocate, and yeah, so I'm going to go have a catch up with him, so I'm looking forward to that, actually.
There's so many ties back into this topic that we've talked about today. Everything seems to come back to fire somewhere along the line, Steve.
Yeah, I'm not going to have a fire in the garden.
No.
I'm going to do a bit of running, and I'm playing bridge tomorrow night. That's what I do on a Saturday night. That'll be fun. It's always fun when I start, but after a few white wines, I start to lose, and then all my bad habits come to the fore.
I'll be doing some studying this weekend, and then normally my reward on a Saturday night is to go for a beer, which I'll be able to do indoors this week, which is lucky. Looking at the weather there today.
Yeah.
Well, a beer and a curry possibly, which we'll not be cutting back on, despite what Fire might say. There's no one,
Well, there
no
is a
one's going to
link.
get between me Fire and me curry and me beer and whatever else. So
Yes.
absolutely not. Well, look, that's great. Thanks very much for Daniel, Steve, and George as well. Thanks very much to you for tuning in to another Do More With Your Money podcast. Hit that subscribe button, because not only will you not miss these, you won't miss George and his team on the morning markets as well. So from the Pod, it's bye for now.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.